It's now, okay, this meeting is being recorded, that's what it's saying. Anyway, yeah, so it's now 7:49 here in Edmonton, Canada. It's in Alberta. And I'm sure that, people joining here are from different time zones. And so, yeah, and well, it's nice to meet all of you here in this session. And let me start with my presentation. As you see, that is saying that causes of systemic banking crisis in advanced economies, asset bubbles, and capital inflow bonanzas. So in this paper, what is the basic motivation? I have 20 minutes, right? So what is the basic motivation here? So what we find here that in academia and policy circles, discussions on possible measures for averting a future systemic banking crisis always ends up with talks on appropriate monetary and macroprudential policies to abate the growth of private sector debt and financial sector leverage as the main driver of systemic banking crisis. So basically, what we have got is that, from the discussions and from the policy prescription is that the credit boom is the primary driver of systemic banking crisis in advanced economies. And of course, there's a very important paper by Schulerich and Taylor, 2011 and 2012. There are two papers, and first paper was three. Also, Joe Dow was there. Uh, So basically, it highlights that, and also other papers, that is credit boom is the main driver of systemic banking crisis. Asset market bubbles are recognized as an important and frequent precursor of systemic crisis, but it is often thought to be caused by the credit booms. Okay, so those kind of bubbles, asset bubbles, are thought to be caused by credit booms. Now, what is interesting in this whole new narrative, like in this development of this literature, is that this development has been shaped by findings of studies that either analyze systemic and non-systemic banking crisis together, simply as one genre of banking crisis. So they don't differentiate between. Well, there are lots of papers like that. There are some papers, of course, which differentiate between systemic and banking and non-systemic crisis, but there are papers which do not. And there are also papers which just omit real house prices, and sometimes both real house and stock prices altogether. So, for example, in the paper by Schulerich and Taylor, is very, very famous by now and very well known, there is no mention of real house prices there. Okay, so they don't examine explicitly real house prices, although there is mention of share prices. Now, some of the studies do not even distinguish between crises of advanced and developing economies. It's basically, if you think about it, like, the dynamics leading to the systemic crisis in developing countries are supposed to be, are expected to be different from the dynamics in advanced countries, the leading crisis in advanced countries, because of many reasons. So the one reason is that the regulatory environment is very different. Most advanced countries have, more robust and more stronger regulation, and people comply with regulation more often than in many developing countries, not all developing countries, of course. So yeah, so that's one reason, and there are, of course, many other reasons why we should not put all of them together. Now, to the best of my knowledge, no study explicitly examines the role of changes in market participants' risk perception. So one is that the systemic and non-systemic, and the other is like real house prices and real stock prices. And then the other thing is the other important missing element in the literature is no reference to risk, how market participants' risk perception changes. Now, some of it is actually caused by lack of data. Early studies like 2011, 12, 13, not reliable data was available at the time. So because of that, it's like many authors could not incorporate many of the desirable elements. But recently, there have been some changes and more data are available on many variables, many crisis indicators. So it has become a bit easier to do this kind of analysis. Now, what questions we are asking in this paper? What forces lead up to the post-war systemic banking crisis in advanced economies? What are the roles of housing stock and credit booms in the run-up to this crisis? Do changes in risk perception contribute to these booms and eventually their collapse? Is history any guide for future policies? So first thing we do before going into any kind of analysis or building any kind of models, the first thing we do is look at the graphs. Like, so should we not distinguish between systemic crisis and non-systemic crisis? Should we not study the systemic crisis as a separate group in a separate sample, as part of a separate sample? So we look at the evolution of some indicators 10 years prior to systemic crisis. So what we have done is taking the averages of all these indicators across crises in different countries, and then see how it goes. Like, what is the average evaluation? So basically, we're asking what is the evolution of indicators prior to a typical systemic crisis. For example, you see here this real house price. So we have labeled here non-systemic crisis and then systemic crisis and the global financial crisis. So basically, these are systemic crises, and then global financial crisis, the countries which experienced crisis, those are also systemic crises, but we have taken them as a separate group, but also this global financial crisis is included in this systemic crisis. So, but let us check if they have similar trends. And it seems that yes, if we take all systemic crises together in advanced countries and just the global financial crisis, they have similar trends. And the non-systemic crises, like, the rising real house prices, rising prior to the systemic crisis, but not so prior to non-systemic crisis. Similarly, for real share prices, yes, we see that, rising trend for all types of crises over a few years prior to the crisis. But now coming to current account balance, we see that the current account balance, as a percentage of GDP falls, falls like over 3 years prior to the crisis, but we don't see similar trend for non-systemic crisis. Okay, now then private sector debt. Clearly there is, a boom, a very prominent boom prior to the crisis, but not prior to the systemic crisis, but not for non-systemic crisis. Not the height of the boom is much lower. Then mortgage debt, similarly, we don't find a rising trend, but then there is a clear rising trend for systemic crisis. Then the spread between the long-term interest rate and the short-term interest rate over 10 years prior to post-year banking crisis in advanced economies. You see, prior to systemic crisis, there is a clear downward trend over 3 years, although it suddenly rises from 7th or 6th year, and then there is a clear downward trend from 4th year or 3rd year, but we don't find any. It's kind of mostly flat for non-systemic crisis. The difference of returns on risky assets and safe assets, similarly, we find, it's rising from 6th year to, 5th or 4th year, and then, it's like coming down, but we don't find that's a similar trend for non-systemic crisis. So this actually tells us that, there is something going on before the systemic crisis, which are mostly common across the countries, but we don't find similar trends for non-systemic crisis, and that justifies studying systemic crisis as a separate group. And that's what we do in this paper. And we also include many other missing indicators of crisis. Like our model is the logit model. We use logit model. There are 104 bivariate and multivariate logic model specifications. Different type, we do a different types of analysis, and we check robustness of the results across loose and strict definitions of crises, and also in other ways. So we just traditionally, what is conventional, we check the joint significance of coefficients with Wald and likelihood ratio tests, as well as individual significance of individual coefficients. And then we consider this goodness of fit measures, McFadden's pseudo R-square and AUROC. AUROC
10 minutes.
Valid. Hello? Yeah.
10 minutes left.
Yeah, thank you. The AUROC statistic evaluates the model's prediction performance at all possible thresholds, and that is independently of the policymaker's choice. So basically, this is evaluating the performance of the prediction performance of the logit model specifications. So I'm not going into these mathematical expressions and all that, because as you know, like the time is limited. But I know that people are by now very much familiar with the statistics. Okay. and the methodology, and then what we do here, one set of logit model specifications we use for predicting crises and tranquil years. So we check which specifications predict the crisis and tranquil years best. Then another set of logit model specifications we consider to check if capital inflow bonanzas and changes in the short-term interest rate raise the joint probability of a housing, stock, credit, or mortgage market boom and a systemic banking crisis in the next 6 years. So suppose there is a boom in credit market or mortgage market, or real estate market or stock market, and following that there is 6 years. Within 6 years there is a systemic crisis. So that kind of event, this joint event, can it be predicted with capital inflow bonanzas and changes in the short-term interest rates? So that is another set of logit model specifications. Now, when we talk about boom, what is boom? Boom is a deviation from the long-run average by more than one standard deviation. Okay. So these are the traditional indicators. Some of them are missing in some papers, but other papers utilize them. But not all of them are present in all papers. So these are the traditional indicators of crisis. Of course, real per capita GDP, real house prices, house prices to rent, house prices to per capita GDP ratio, real share prices, and private sector debt and mortgage debt, current account, short-term real interest rate, and income inequality, investment to GDP ratio. Okay, and then we also, in this paper, is entirely new. What is entirely new is this indicators of risk perception, how the risk perception of market participants change. That is also a point of interest. So we consider 3 alternative measures of risk perception: the spread between the long-term interest rate and the short-term interest rate, difference of returns on risky assets and safe assets, difference between equity capital gain and dividend return. Now, so we examine the indicators in first differences as well as in deviations of 6 and 9-year growth rates from the long-run average. Data range is 1966 to 2012. Now we have 16 advanced economic banking crisis episodes, and we use balanced panel of data. That means each country had the same data range, like for each indicator, 1966 to 2012. But in some cases, we couldn't strike the exact balance panel, but short of a few short for a few of the observations, but otherwise they are balanced, mostly balanced panel. And the data sources, macrofinancial history database by Jodda, Schulerich, and Taylor, International Financial Statistics, IMF World Economic Outlook database, and World Bank data. Okay. Now we also, as I already mentioned, that we also do robustness checks. There in crisis definition, we get systemic crisis, banking crisis definition we get from Levin and Valencia. But they also identify a few systemic crises as borderline cases. So we checked this, if the results vary, if we drop the borderline cases. So
5 minutes.
So that's, yeah, thank you. And then across alternative housing market indicators, and then across alternative risk perception indicators, across smaller and larger samples with, and with alternative linear probability model specifications. So we use logit models, but we also derive the same results with alternative linear probability model specifications. We find that our results are robust across this, the alternative definitions and indicators, alternative indicators, and larger and smaller samples, and also across alternative models. Okay. So what are the results? Basically, what we find is bivariate specifications for predicting crisis, persistent deviations from the long-run trend in the real estate market, the stock market, and the mortgage market explain and predict the post-war systemic banking crisis in advanced economies best. Now, in the first difference form, the risk perception, these are for only the bivariate, only one variable, and then the crisis variable. Only one explanatory variable and the crisis variable as an independent variable. Now, in the first difference form, the risk perception indicators perform equally well as housing, stock, and mortgage market indicators in the deviation form. So, now in the multivariate specifications, we find that together the deviations in real estate and stock markets from the long-run trends predict the systemic crisis very well. Capital inflow bonanzas and changes in the risk perception have additional predictive power in the multivariate models, even after controlling for the real estate and stock market variables. And then increases in the short-term real interest rate also have some additional predictive power, but not as much as capital inflow bonanzas. Now, interestingly, deviations in the mortgage and credit markets, which have been highlighted too quite often in academic discussions and academic deliberations and policy discussions, we don't find them to be significant when we control for the effects of real estate and stock markets and capital inflow bonanzas. Okay. Now, the bivariate specifications to predict the joint probability of an asset or credit boom, we find that capital inflow bonanzas have significant effects, and then short-term interest rates only have some effect on the stock market variables. Now, coming to the last slide, I hope that I'm on time. So post-war banking crises in advanced economies are primarily caused by boom-bust cycles in housing and stock markets, associated with changes in financial market risk perception. So basically, we find that is the primary driver. If we have to identify any primary driver, then is the boom-bust cycles in asset markets, housing and stock markets. And then we also find that the market participants changes in market participant risk perception is also an important factor here. Now, similar booms in credit markets do not add to the model's explanatory power that combines housing and stock market dynamics. Cycles in credit markets are driven in part by cycles in real estate and stock markets before the crisis. Capital inflow bonanzas often fuel stock and credit booms, driving the systemic crisis. So it's not that capital inflow bonanzas are causing most of the time, but when those booms happen, capital inflow bonanzas can fuel those booms. So it's kind of catalyst. That's what we are finding, is they're not necessarily the primary drivers. Now, these findings indicate extrapolative forecast and neglect of tail risk driving asset market boom bust cycles and systemic banking crisis. So basically, we find some support for the diagnostic expectation hypothesis by Gennarelli and Schleifer, 2018. And then policy implications, counter-cyclical measures to limit not only credit booms, but also asset booms, real estate and stock booms, and cooperation at the global scale for capital control measures and a stable international monetary system. Well, so that's the end of my presentation, and thank you very much.
Exactly on time. So I appreciate that. So as I mentioned, we're gonna keep questions. We're gonna hold questions until the end of all presentations, just to make sure that we keep on track. So thank you, Satinil. If you could please stop sharing your screen so that Pablo can share his screen.
Thank you.
Pablo, Lara, the Credit Center at CUNY is the next presenter. So whenever you are ready, Pablo.
So what I have here is the PowerPoint presentation. Okay, let me see. Yeah, I should be.
You stopped sharing, so Pablo, you should be able to share yours.
Okay, I think everybody can see. Let me just put it in presentation.
Okay, yeah.
Okay, so thank you all for being here, and I appreciate the opportunity. I'm going to present you my paper, House Prices, Aggregate Markups, and Monetary Policy. And yeah, so without further ado, so the motivation for this paper is that there is recent evidence that house prices may affect the evolution of local retail final prices, or the price of final goods. And in particular, there's this paper by Strobel and Vavra that finds that there's an effect of house prices on the prices that local retailers charge. So what this means is if there's an increase in house prices in Orange County in California, they observe that there's an increase also in the prices that retailers situated in Orange County in California also charge. And so, yeah, this is a positive relationship. As house prices increase, so do local retail prices. And importantly, this only happens in zip codes with high home ownership rates. So they look at the variation across zip codes. For example, in zip codes where there's a majority of renters, of home renters, this effect either doesn't happen or happens much more in a smaller fashion or more weakly. And well, they try to explore possible relations for possible reasons for this relationship, such as maybe the rents that retailers are paying increase. Maybe they are paying higher labor costs. Maybe there's income gentrification. And it turns out that all of these reasons don't seem to explain that much of the variation. It turns out that what changes, or when they explore the data and they have proprietary data for a particular retailer, they find that there's a change in the markups that that retailers charge. And what is the explanation behind that, or the conjecture that they give, is that if there's a change in housing wealth, well, local house homeowners have an expansion in the value of their wealth, and therefore their price sensitivity or the demand elasticity decreases. And an optimal response to this from retailers will be to increase their markups, right? As we know that as price sensitivity or price elasticity decreases, markups increase. Now, these are very interesting results, but they rely on microdata and local level data. So it is not evident that they should hold at the aggregate level, in particular because shocks in one region may be offset by shocks in another. The retail sector, so they find that this applies for the retail sector, but the retail sector turns out to be only 5% of total value added, approximately. And it might be the case that this type of relationship doesn't hold for other sectors in the economy. So it's not evident whether or not this should hold also when we look at the aggregate data or the economy as a whole. So, however, understanding whether or not this is the case might be, or is an important empirical question, because it might have business cycle implications, right? What are these business cycle implications? Well, for example, right, when we have endogenous markups, they might react to, or sorry, when you have markups that react to house prices, they might react also to expansionary policies, such as decreasing the interest rates, house prices increase, markups increase, and this creates an acceleration of inflation. Importantly, also distinguishing between two different sources of inflation dynamics may be important to maybe design two different policy interventions. And in particular, the literature is missing a model that incorporates this relationship in it. For example, most medium-scale New Keynesian models do include time-varying markups, but they do so mostly exogenously. Models like Cristiano, Motto, and Rostaño, Justiniano, Primicento, Belotti, to name just a few. And what these models have is that by construction, the evolution of markups is countercyclical, meaning when there's an expansion, markups decrease because there's a decrease in marginal costs. So this is very not very flexible in a way. So also incorporating this relationship might be important in giving more flexibility to models and adding maybe a bit more realism to them. So in this paper, I tried to answer two research questions. The first one, which is empirical, is does this relationship between house prices and markups hold at the aggregate level? And my second question, which a bit foreshadows the results from the first one, but it's a more theoretical one, and is what are the business cycle and policy implications of this relationship? So what I'm going to do, what do I do in this paper, is to answer the first question, I first construct a quarterly series of aggregate markups following the methodology of the paper by DeLocker et al. Of 2020. What I do is I construct a quarterly series and then I put it into a VAR with other aggregate variables such as the interest rate, the inflation rate, aggregate house prices, the aggregate markups themselves, and real output. And then what I'm going to do is I'm going to use the impulse response functions, the IRFs from this system, to understand what is the joint behavior of the variables at the aggregate level. And then to answer the second question, which is more theoretical, what I'm going to do is I'm going to extend an off-the-shelf New Keynesian model, which includes a housing sector and collateral constraints, and it's based on a paper by Jacobiello, 2005. So what is the extension that I do? It's very simple. I add time-varying markups to the model. The original Jacobiello model doesn't include time-varying markups. And on top of that, I'm going to make them depend on house prices or change according to the evolution of house prices in a spirit similar to what Strobel and Vavra find at the local level. What are my results, or what is the overview of the results? Well, like I said, I already foreshadowed a bit. The first result is I document that there is indeed a positive co-movement of markups and aggregate house prices in the aggregate economy or in the economy as a whole. To the best of my knowledge, this is the first paper to confirm this relationship at the aggregate level. And well, from the VER, there's not much more to say. I also find other stylized facts that I'm going to tell you, but they're pretty standard, so there's not much to add to it. So the first contribution would be finding this relationship between house prices and markups at the aggregate level. And then turns out that the model, the off-the-shelf extension, the extension of this off-the-shelf model can actually replicate the stylized facts that I find from the first section from the VER fairly well, especially qualitatively. Some of them, as I'm going to show you, I don't fully explain, but it does a pretty decent job. And on top of that, the model allows me to understand what are the aggregate implications of counterfactual scenarios. So for example, what happens if I shut down the channel from aggregate markups being endogenous? Meaning, what happens if I go into a world in which aggregate markups are exogenous, as they have been treated in most New Keynesian models up until now? And another question that I can ask is, for example, what can the central bank do in the presence of aggregate markups? Do they need to change their approach? Can they do something to implement the optimal monetary policy or not? And what I find is that even if the central bank believes that markups are exogenous, even if the central bank believes that we live in a world in which markups vary, but they vary exogenously, they can implement something, or they can approximate the optimal monetary policy by just reacting to a standard Taylor rule, essentially reacting only to the output gap and the inflation gap. So just a brief literature review, because we don't have too much time, but this paper is related to various strands of literature. For example, it is the aggregate counterpart of the paper by Strobel and Vavra, so it is linked to the paper in that sense. Also, in what concerns measuring aggregate markups, since I used the methodology of DeLocker et al., well, it is really closely related to that, but there's also a literature that tries to measure markups at the aggregate level. For example, there's a different methodology proposed by Hall in 2018 that uses national accounting data. And obviously, it's also related to new Keynesian models that have either a housing sector or time-varying markups. Like I said, the original paper by Jacobiello, of which this is an extension. There's other papers like Jacobiello, for example, Jacobiello and Neri, that includes a housing sector and tries to answer a different type of question. And like I said, there are models that have new Keynesian models that have time-varying markups, but the variation is exogenous, such as these ones. And finally, it is also linked to a new literature or a literature that is rising right now that tries to look at the macroeconomic impacts of markups and industry concentration. For example, Edmond Midrigan and Shu that tries to measure what is the effect or the cost that markups can have in the economy as a whole. This paper, this IMF working paper by Fuceri, Lee, and Tavares also looks at how monetary policy transmits through different firms, or how firms react to monetary policy shocks according to the markup, so to the level of market power in a sense. And it's also, let's say, related to the paper by Altor et al. About the story of superstar firms, of how industry concentration might affect macroeconomic outcomes. So
10 minutes.
Yeah, thank you. To go at the first part is I first need to construct a series for quarterly markups. How do I do so? Like I said, I use Compustat data, which is the same source that De Lockeret, Ekhut, and Unger use in their own paper. And I just apply the methodology. The methodology allows me to calculate a firm level markup, which is given by this ratio of two elements that I observe in the data, which is total sales and total expenditure in a variable input. And these are directly available in the data. I have an additional parameter that is called the output elasticity of the variable input, which is just how much output increases as the variable input increases. This is estimated. And once I have these estimations by industry, these are estimated by industry year, I have a firm level markup. What do I do then? I can aggregate this firm level markup across firms per period by using different weights. These are the M weights. And I end up with an aggregate markup per quarter. Once I have that, I can construct the series that I need. And this is how quarterly aggregate markups look. On the left panel, I have that they have been increasing. So this is in line with what De Lockeret and et al. Find in their paper, which is since the early 80s, markups have been steadily rising in the US. And yeah, what I do is I use a Baxter-King filter to extract the trend and the cycle component of this whole series. And here, just to show you how they might evolve, or how markups and house prices evolve at the aggregate level, I also include a series of real house prices, and we can see already that they do seem to have a positive movement just by eyeballing the series. And then what I do, well, now I have my series for quarterly markups, aggregate markups. Now I can incorporate it into a VER and use the IRS from this system to understand what is the joint behavior of markups with house prices and other variables in the economy. In particular, it's a VER2 that has, it depends on its own lags of itself of order 2, and it also includes some exogenous variables such as a time trend, dummy variables for monetary policy, and an aggregate index for commodity prices. Now, the first fact that I document is what I told you is after this housing price shock, so there's a 1 standard deviation positive shock to house prices, I observed that both inflation and markups increase. Now, this is the aggregate counterpart of Strobel and Vavra. This is the main empirical contribution of the paper. But I also document 2 other facts. One is that after this positive markup shock, meaning markups rise above their trend by 1 standard deviation, well, I observed that output should decrease and house prices should increase. And finally, my third stylized fact is that after this positive shock to output, meaning when outputs rise above prices above its trend by 1 standard deviation, I observed that markups also rise above the trend and real house prices also rise above the trend. And now this is just the empirical data results. Obviously, there's a lot of going on. This is not causal. This can be only let's say, heuristic in a sense. It just tells me what the data is telling me of what is the aggregate movement of this. Now, up onto the model, what I do is I just extend the model of Jacobiello. It's a model that has 3 types of agents. It has entrepreneurs who consume and use housing as a factor of production alongside with capital and labor. So here, housing fulfills 2 roles. It serves as an input of production, but it also is demanded by households, there are 2 types, and I need 2 types in order to have financial constraints here that depend on the value of housing wealth, and that's what's going to give me some of the dynamics for housing. Housing is in aggregate fixed supply, which means any housing demand shock is going to be translated directly as a price shock, as an exogenous price shock. And we have retailers in this economy. So entrepreneurs produce an intermediate good, which is just then taken and costlessly differentiated by retailers. This is just done to add price expression to the model. And also, since they face Calvert rigidities, it also adds price persistence. And in the end, the final good is just a Dixit-Stiglitz aggregate of the varieties. So retailers are also giving me the markups part of the model. And then the model is just closed by having a central bank that reacts to a Taylor rule that tracks inflation, output, and the past or has some persistence in the interest rate rule. Now, where does my model deviate from the Jacobiello paper? It's just in 2 very simple elements. One is the new Keynesian-Phillips curve that is given by this equation now has an added element that depends on aggregate markups. And this is very common in all papers that include time-varying markups. This additional element appears in the new Keynesian-Phillips curve. But on top of that, those papers that have a law of motion for markups that looks something like this, it's just an AER or an autoregressive process. What I add here is just an element that depends on the evolution of house prices. And this reaction, or how sensitive markups might be to house prices, is governed by this parameter that just governs the elasticity of change of markups with respect to house prices. And this is going to be This is going to be estimated in order to match the data, as are other parameters in the model. So once I do that, once I estimate the model parameters in order to match the data, I compare the results of my model with the data. And I observe that after the housing price shock, the model does reproduce the increase in markups that occurs, and it does reproduce the increase in inflation. It's not perfect because obviously there's that kappa parameter in the new Keynesian-Phillips curve. So this might be quantitatively a small shortcoming, but qualitatively, it is able to reproduce it fairly well. It also reproduces, the second fact is not fully reproduced because after there's a markup shock, I do observe output decreasing, but however, house prices also decrease, whereas the data tells me that they should increase. Now, this is very difficult to reproduce with any model because when there's a decrease in output, it is very different to difficult to have something that justifies house prices increasing at the same time that output is decreasing. And on the other hand, after this positive output shock, I also observe house prices and markups increasing. Now, I'm not going to have enough time to show you the business cycle implications. Let me just tell you that a model with exogenous markups, so a model in which phi that elasticity of markups with respect to house prices is 0, doesn't differ that much from the model with endogenous markups. Now, the next question I ask is what happens if the central bank, wants to minimize a function that depends on a convex combination of output volatility and inflation volatility. Now, the question that I ask is, should the central bank first react to house prices? So should they include an additional term in their Taylor rule to track house prices? And what I find is that indeed they shouldn't. So this is also very common. This is also a result of the Jacobiello paper. These lines here show me the efficient frontiers, essentially telling me what's the best combination of both output volatility and inflation volatility that the central bank can achieve if they are minimizing that function for different weights of omega y and 1 minus omega y. And I observed that the 2 lines are almost superimposed, which means that the central bank doesn't gain much by reacting to house prices. Now, the next question that I ask is, what happens if the central bank has the wrong model of the world. Essentially, what happens if the central bank thinks that markups are exogenous when indeed they're endogenous, will reacting to asset prices make a difference this time. So I do both cases, sorry. Here, they are not reacting to house prices, and here they are reacting to house prices. The blue line is the actual model of the world, which is house prices are endogenous. Thank you. I observed that, again, the two lines are almost superimposed. And what this shows me is that even if the central bank thinks that markups are exogenous, when in reality they're not, it doesn't gain much. They can actually approximate the efficient frontier or implement the efficient policy by just reacting to the inflation gap and the output gap. So this together tells me that markups do not matter that much in terms of aggregate business dynamics. Now, what do I do here? So just to recap is I construct a series of aggregate markups, quarterly aggregate markups. I put it into a VAR with other aggregate variables. The IRS from that VAR tell me that indeed house prices and markups can move positively at the aggregate level. Then I extend an off-the-shelf New Keynesian model based on Jacobello 2005. The model replicates these facts fairly well, but I think it lacks a richer structure to match the data more closely. And so far, what the model suggests is that the central bank does not gain much from reacting to asset prices, nor does it lose too much by not reacting directly to markups. Even if it thinks markups are exogenous when in reality they're endogenous, they don't gain much. And this is what that's it. Thank you very much.
Thank you, Pablo, for the presentation. We're finishing again right on time. So next is Andre Doherty at the Federal Reserve Bank of Cleveland. Whenever you're ready, Andre, please go ahead.
Right. Can everybody hear me well and see the presentation well?
Yes.
Yes.
Okay. Can you see it moving around?
Not yet.
Okay.
We see the main the first screen in your presentation. It wasn't moving.
Okay, this one, maybe this one is moving on.
Yep, that's working.
Perfect. All right. So thanks everybody for being here, and always happy to be here at LaSalle. So this is a paper with colleagues of mine, Fernando and Fabio Gomes, in University of São Paulo in Ribeirão Preto. I'm André Victor, and as I work for the Federal Reserve Bank of Cleveland, I have to say the disclaimer that the views expressed here are solely mine and of my co-authors, not of the Federal Reserve Bank of Cleveland or the Federal Reserve System at all. All right, so this paper is going to be titled "The Welfare Cost of Business Cycle Unveiled and Measuring the Extent of Stabilization Policies," and probably is going to differ a little bit from the other papers in the sessions. It doesn't tackle business cycles totally. It actually talks about the welfare cost of business cycle and kind of like thinking about the flattening of those business cycles. But the idea of this paper is basically to come back and do a re-understanding of a classical calculation by Lucas. So as I'm sure all of us know here that, Lucas in '87 proposed a framework to measure the welfare cost of business cycles. And the idea that was to compare an uncertain consumption flow with an expected value of that consumption flow, like a flat consumption process, right? And that was the idea of Lucas of smoothing that consumption flow. And what Lucas found is that, once you kind of like did a very tractable, very simple, only preference-based calculation of this comparison, you would understand that the welfare cost of business cycle is just a very small thing, kind of like it wouldn't hurt that much to actually consumers to give up that smoothing in terms of consumption equivalent variation or lifetime consumption. And then, of course, as the result is a little bit upsetting in the sense that, it tells us that the good that macroeconomic policy can do is very small. There was a prolific literature that stemmed from it, changing the environment, changing preferences, shock compositions, shock processes, and etc., in order to see whether we can augment the size of the contribution of the flattening of welfare costs of the cycles. But then there is something that is subtly mentioned in Lucas' analysis, and that has been very important for all the improvements in the literature we've seen so far, which is that these stabilization policies they are always in course. So that means whenever we gather data, any type of macroeconomic aggregate data, especially consumption data, this data is exposed, right? It is realized. All of this data is subject to the status quo of stabilization policies that are always in course and that are always there. So whatever consumption data that we gather and that we organize to put into our models is partially smoothed, right? So the idea is that, if you would like to think what is the actual full benefit of those stabilization policies, you'd have to have some sort of like measure of consumption that is on the back of what we see in the data, which is what we could call here the laissez-faire consumption, which is the type of consumption that will be allocated in the works maximization problem, absent any type of status quo of stabilization policies. So this laissez-faire consumption series is not directly observed. And if you want to kind of like find a map between what is the full extent towards the riskless consumption, you have to come back and try to define this laissez-faire consumption series. So the question of this paper is how to find this full benefit. And we're going to propose a methodology to actually try to do in a tractable way, a comeback to this idea of this counterfactual measure. So the paper is going to basically be of two parts. Since we have very little time, I'm actually going to spend a little bit of time explaining here more in words, and I'll show you a couple of the results in a second. But the paper has two parts, right? We're going to first just propose the composition of the welfare cost of total fluctuations. We're going to call total fluctuations this welfare cost that is hidden by the fact that there is a consumption laissez-faire measure that is not subject to the status quo of stabilization policies. So we're going to postulate, and this is going to come from an idea that is present in one of the papers in the literature, Alvarez and Yerma, that the consumption that we observe, the observed consumption, is a mix of a perfectly smooth consumption, which is the Lucas flat riskless consumption that he was searching for in terms of business cycle fluctuation flattening, and the laissez-faire consumption. So what is observed is just basically a mix of those two types of consumptions. And we're going to use a very simple tractable formulation, a weighted geometric mean, so the Cobb-Douglas style, with this parameter theta that is going to govern the share of each part of consumption in the mix of observed consumption. So that theta, also in a homage to Lucas, we're going to call the span of stabilization power, tracing it back to the vocabulary of the span of control model, which is a different type of model, but we like to use the same nomenclature as Lucas here for our parameter theta. So then with that decomposition, we're going to see that the benefit of ongoing policies, whatever is the benefit of what's happening right now, plus what is left to be smoothed, which was actually the holy grail of the literature before, the sum of these two is actually what's going to be the welfare cost of total economic fluctuation. So the idea is that we have to take into account more seriously if we think of this idea that the data is sort of like, quote unquote, polluted by the status quo of stabilization policy, that we have to actually see what is the benefit of what's happening right now. Then with the composition in hand, we're going to show that we're able to apply it to two of the classical processes of consumption shocks that we have in the literature, the Lucas 87 process, which is the transitory shocks, and the Obstfeld process, which are permanent shocks. But then after we are able to actually do the algebra and find our decomposition in those terms, we're going to hit a challenge. And that challenge is going to be, well, since the observed consumption is a mix of a laissez-faire consumption and a riskless consumption, well, the riskless consumption is very simple to calculate, it's just the expectation of it. But the laissez-faire consumption is something that is counterfactual, right? It's not observed. So the theta is going to be tied to a measure of consumption that we don't observe. So we're going to have a challenge on identifying that data to see how we can trace it back to the data. So we're going to propose an identification strategy for that. We're going to use a very long series of consumption. Most of you might be familiar with it, the Barrow and Ursula series. And we're going to use a little bit of the idea of identification macroeconomics, precluded by Nakamura, Stice, and others, to sort of like discipline a little bit the identifying on that data. Excuse me. All right, so what is the preview of the estimated results and the intuition that we have? So what we're going to find is that, the stabilization policies that are in course, right, they already stabilize in 50 to 65%, depending on the way you choose a transitory versus permanent, depending on the risk aversion, depending on the persistence and the discount factor. Depending on a lot of parameters, we're going to find a range of 50 to 65% of the consumption shocks are already smoothed by the current ongoing stabilization point. So that's the span theta hat. The estimation of the reach of the stabilization policy is going to be something that is almost 65% of the consumption shocks, which is a lot, right? So we have to give due credit to what is already being done. And then we're going to find the total cost of economic fluctuations, considering transitory shocks, which is not our preferred measure, not even the preferred measure of literature, but we want to kind of like have a benchmark there. there's going to be like a 1.25% of lifetime consumption for the total cost. That's already way more than what we see in the traditional Lucas calculation, because we had 100% back there. So we already are on the ballpark of above 1%. But if you consider permanent shocks, which actually describe it a little bit better, especially if you think of the finance literature and the fact that we have an integration there, it's going to go up to 6% of lifetime consumption. So what we see is that, whatever is left to be, being done is going to be just 20% of that, out of the total part, or the residual that is being left is about 20%. And if we try to compare even that part that is kind of like a little bit different than what it is before, which is the residual to be smoothed, is already 50% higher than the equivalent way of measuring what the literature was after in our formulation. So overall, if you consider a little bit more the fact that the laissez-faire consumption is not observed in the data, and you try to estimate that, what you get is that you have to give due credit to the stabilization policies in course, and you're going to find that the benefit is higher. Then we're going to have some interesting intuition that comes there. The first thing is that what I've been telling you so far is that, if you want to think about the total cost, you have to consider counterfactual measures, and that is important, and that you need an empirical identification effort on that. The second thing is that due to the concavity of the utility function, given a policy theta hat, given a reach that a policy can do, the marginal benefit of smoothing a residual fluctuation is decreasing on the this relative degree of risk aversion, right? So the more risk averse consumers are, the less you're actually going to be able to find that this is efficient program, okay? All right, so I'm not going to dwell very much in the literature since we don't have that much time. But the paper is related to the welfare cost calculus literature, pretty big literature that started by Lucas. We're going to talk a little bit with identification macro literature, Nakamura, Tyson, and others, Jorda and Schulerich, and other great papers out there, even more recent ones. And we're also going to talk a little bit of macro history data, because there's an issue in terms of the measurement, and the seminal take by Christina Romer on the spurious details of macroeconomic series. I'm going to be able to talk a little bit about that too, because the methodology will be flexible enough to think about those issues, right?
You have about 10 minutes left.
Okay, perfect. That's great. So half of the talk is gone, but I'll try to select a little bit to just show you the results. So just there's a notation, and then I'm going to be able to talk about the details of the model. This laissez-faire consumption I was mentioning is the C2, the series that we have there. The C-bar series is the smoothed consumption that is right below in the second bullet point. So whenever we want to think about the total cost of economic fluctuations, and we're going to do the way the welfare cost calculus literature does, which is like this pure preference based, no model, nothing, just write down preferences and try to find the lambda. That's going to be what we're going to do here. We're going to try to find the lambda cap t. So the lambda cap t is allowing us to get a mapping of the distance in terms of expected discounted utility of the C tilde and the C bar, right? So that's what the lambda is making it here, is the wedge of one to the other. That's going to be the total cost of economic fluctuations. So for you to see graphically, and this is going to help me go through the model faster, from C tilde to C bar, you have the arrow here in the direction of less risk, right? The lambda cap t is capturing in terms of equivalent variation in consumption, the distance of these expected utility measures. Then, a bunch of technical assumptions for summability, for finiteness, and the consumption process. I'm not going to dwell on that today for the purpose of the talk. We're able to characterize lambda t given an arbitrary way of posting a log consumption series, okay? We're able to calculate that. That's what we found. Now, second part that is important, observed consumption. Observed consumption now, given a theta 0,1, which is going to be the span, the reach of the government, the observed consumption CT of theta is a mix of the laissez-faire and the smooth consumption. That's the Cobb-Douglas weighted geometric mean way that I told you about, right? So we postulate that observed consumption is just simply a mix of the two understandings that we have of consumption out there, and we can rewrite everything. Once we have, did that go fast? Okay. So once we have the C tilde, we're able to come back here and find the benefit of ongoing stabilization policies, which is going to depend on theta now, which is going to be the mapping of C tilde to the observed consumption. So in terms of our little figure there, observed consumption is in the middle here of our flow of less risk, and benefit of ongoing policy is the mapping from C tilde to the observed consumption. And as you can imagine, we can calculate, characterize, and then we're going to be the third measure, which also is going to depend on the level of stabilization of the government, lambda R, which is the lambda residual, and that's going to be what is left to be done from observed to C bar. Okay, so those are the three lambdas we're after: lambda cap T, lambda cap B, lambda cap R, right? Given the fact that we have a very tractable decomposition, we're able to just tell us about the main theory of the paper, which is the lambda cap T can be decomposed in lambda cap B and lambda cap R, and we can do a similar approximation. All of us have done some log normalization and Taylor series and whatever, we know how to do that from those calculations. All right, so we can apply to Lucas, lots of algebra there because there's a transitory shock here. We can apply to Obstfeld, also algebra there. But now I'll talk very fast about the specification before I get the 5 minutes alert. So the idea here is that we want to compute lambda cap T, lambda cap B, and lambda cap R, right? So if you come back here, suppose that we are here on this consumption process here of Obstfeld. We have a trend, we have a log normal process here. XTO is defined as the sum of permanent components here, the way Obstfeld intended, okay? If we just take log on that consumption process, if we apply it to the CT of theta in our formulation, you're going to have to trust me here because I don't have time to do the algebra. We're going to have the log organization here very simple. We can take a first difference to get rid of the additive component. We're going to end up with this term here. When you look at it, this is just a simple regression on consumption, right? On an intercept and a shock, which is more or less what we want to think about the consumption series. But the problem is we have three parameters: alpha 1, theta, and the variance of the shock sigma square epsilon. So if you go here and you estimate this regression here, in your intercept and in your shock component, the parameters are going to be hidden in convolutions and scale that is not going to be able to identify them. There's going to be two parameters mapping to one intercept and other two parameters mapping to one error term. So whenever we get the estimates, we cannot decouple it back to the theoretical parameters, right? So what we're going to do, we're going to try to seek some variation in consumption volatility, observe consumption volatility, that means the sigma square of U here in the observed regression that we do. And then from that, we're going to be able to trace it back to identification. So learning from Nakamura and others, we know there's a substantial decrease in consumption volatility after World War II, right? Before, a lot of variation, after, less variation. So let's say that we have two periods, 1 and 2, and that the underlying variance, the variance of the laissez-faire consumption is constant no matter what. Nothing changed fundamentally in the way consumption is defined in the decision process of the theoretical minds of our household optimizers. But the sigma squared U, 5 minutes? Oh, okay, but perfect. So the sigma squared U, if you look at it and if you do the algebra, you see that the sigma squared U, now that we do like a Nye period here, is basically this convolution here of 1 minus theta squared times sigma epsilon squared. And if you have 2 points, you can actually come back and say, hey, let's say I have theta 1, right? And or I can guess it. Then I can recover theta 2 if I have theta 1. And all I need is the measured volatility of consumption in period 2 and measured volatility of consumption in period 1. I have a guess or a theory about theta 1 that allows me to get theta 2. That's what we're going to do, right? So then we're going to come here and say, okay, what we would really like here is theta 1 to be 0, because that is going to kind of like neatly identify theta 2. So we have to seek for a period of incipient stabilization, right? We want where the span of the government before was small. So ideally, we want to like theta 1 equals 0. So we're going to reach to that. And basically, we're going to come to Nakamura and Stiles again, use Barrow-Russell data, and come back to previous World War, less stabilization, after World War, more stabilization. That changed consumption volatility. That's the underlying idea. So the theory is less stabilization affects theta. What we see in the data is sigma squared of consumption. And there you go. This is the series from 1840 until today. This is the Barrow-Russell series. We augmented a little more, 10 years here, just coming up and doing the same methodology. And you can see there's a sharp decrease here. Of course, we have robustness on that line. This is, this is the main analysis, but we have no robustness on the line. After Second World War, you can see that the measured volatility of the series of consumption, sigma hat U, decreased substantially, right? And if you guess a theta 1 here, and we are showing here the theta hat for a theta 1 of 20%, if you guess there was 20% of stabilization here before, you recover that is 65% of stabilization later, which is tightly related to the less of consumption. And if you see here, the series actually become a little bit more persistent over time. These are the signs of the great moderation, right? So the variation in volatility is here, the persistence in the series is the moderation, right? So with that idea, we're sharply able to identify theta, plugging into the formula here, given that we can trace down a line which defines the two periods. with that, the same thing can be done in levels. That's for the logs. Consider that the span of the series is a little smaller here, and we consider the same thing what happens for the log. So this is the identification in log shocks. So a little less neat than the one in the permanent shocks, but still works the same way. Okay. Given that, all we need to do is to run our regressions. We have the regressions that I showed you. The regression for permanent shocks, the one I showed you, the one that was like on pi and u. So we get our estimates, and then we have a grid for theta 1 from 0 to 30%. And you have here, we just put a grid to show you that, the choice of theta 1 affects it, but it's, doesn't affect that much because you already start with a higher level of stabilization no matter what. So from 0 to 30, we have that the theta hat can be estimated here. Our preferred is the permanent shocks, and we choose 20% because, two things here. First, we want to give some credit to the macroeconomists before the World War. There was some stabilization there. Perfect. There was some stabilization before the World War, but also there is the idea of Christina Romer that there is a lot of spurious volatility measured in the series. And after the World War, there has been an effort of recalculating macroeconomic aggregate series that has less volatility. So we want to say also that there is a little bit of volatility that was actually not being captured to be smoothed because there was some spurious details there. So we want to give a credit also for measurement error. So the theta 1 can also work as a way of taming measurement error in the pre-period that we have. So we put 20% here to have like a number that is a little higher. And then we got 65% is the reach of the government. So if we have 65% of span of stabilization power in the second period, that means we can come back now that we have a theta, and that's all we need with the theta and all the other parameters that we have estimated. We can come back, we guess a theta 1, we come back all the parameters, we can come back and plug it in our algebra for the welfare cost of business cycles. And this is only for permanent shock, so Obstfeld environment. And you can choose different ones if you want. I mean, we have to do all the algebra to do that. We did it a little bit with the combination of transitory and permanent. The composition still goes through, but it's not in the paper. It's only the case if that's necessity of doing it later. So that's what we see. So here, the total cost of welfare fluctuations, let's use the standard, which is picking up 2.5 a risk aversion. That's standard in the welfare cost theory. Then we go here and we see that with the 65%, there's the 66% of that. And out of that 6% of permanent lifetime consumption that we are smoothing from the laissez-faire to the riskless, 4.74% is the benefit of what already is happening. So there's a lot that is already going on in terms of stabilization policies that we cannot decouple if we don't know the theta, right? Since we know the theta, we can break it down and find the lambda cat B. And then what is left to be smoothed is that 1% that is here, that is missing from our 5.86%, which is already a lot. So macroeconomic policy can do a lot, can still smooth 1% of lifetime consumption, but it is not as much as what is already being done because we already have the setup of stabilization policies there. And we have this little lambda here. This is the little lambda here is that supposing we want to do the same thing Lucas did without having the theta in our methodology, we find an equivalent measure of the Lucas calculation in our methodology. It's a little different, but still getting close to that. If we don't consider the theta, we would have only 0.68%. So we're already coming back to the less of a 1% that comes in Lucas, even though it's still a little bit higher than it would be there. So we still have like, 55% increase on top of this other literature here. So I'm probably out of time already or not?
Yeah, but that's okay. It's my time that you're taking away, so it's not a problem.
Fantastic. So I won't conclude then. The conclusion is that, we propose the tractability, we try to measure it, and we found that welfare cost of business cycles are actually large. A lot of credit has to be given to the current policies, but there's still a little bit to be done. All right, thank you very much.
Thank you, Andre, for the presentation. So I'm going to go ahead and share my screen. Is everyone able to see it?
Yes.
Awesome.
Yes.
I'm going to try to keep track of time as well, but just in case I go over, someone can remind me, that'd be great. All right, so this is the last presentation of the session. The topic again is business cycles. I'm going to take yet another dimension to our understanding of business cycles. And the specific question that I want to address in these papers, whether or not the trend cycle decomposition approach of Hamilton at Restat, which I'm going to refer to as the HD approach going forward, is able to adequately identify asymmetries in business psychodynamics. So this is more of a paper about the ability to decompose aggregate series into their trend and cyclical components, which is an important question that has tangentially been referred to in the different papers. I think probably talked about Baster and Kinfelter to look at cyclical properties of housing prices. Andre looked at the welfare calculation from Lucas, which relies on an assumption of symmetry in the cycle. And so what I'm going to ask here is, given the vast evidence that I'm going to show in favor of asymmetric business psychodynamics, is this HD approach able to adequately capture that? Okay. The measurement of business cycle that I'm going to favor is the output gap approach. There's a number of different ways to think about business cycles. Morley and Piger prefer this output gap approach because it's cleaner in a way and it has more important policy implications. That's what I'm going to follow, since it's what seems to be the consensus in the literature, even though there is still some debate about the appropriate way to measure this decomposition. And so, as I mentioned, there is a vast literature that suggests nonlinearities in business psychodynamics ever since the introduction of the Markov switching model by Hamilton, the original paper. But even prior to that, as early as the 1920s and 30s with Mitchell's and the NBR, early ideas about business cycles being non-symmetric, to more recent papers that argue that there are certain types of specific nonlinearities, time-varying growth rates, even within regimes, as in Owen and Kim extensions of this Markov switching model that allow for a quicker bounce back effect associated to recovery, higher than average growth during recovery, early stages of the expansionary periods, as well as different shapes and different effects of recessions, right? Permanent effects of recessions, as in the original model of Hamilton, to more transitory effects of recessions. The Luo and co-authors paper argue for more transitory effects. A forthcoming Owen Morley paper argue for a combination of both, yet both are still not prevalent. And I have a recent paper that is forthcoming where I argue that we can think of recessions as being a combination of transitory and permanent shocks. But there's also an entire literature that argues for plug-in type dynamics in business cycles, plug-in dynamics a la Friedman. And so just to give you a sense, Sinclair here estimates the US business cycle, assuming plug-in dynamics, where the idea is that recessions are much longer than expansions, and these models seems to fit the data well. Now you may ask, well, this may be a feature of the model. However, Morley and Piger estimate a model-free average measure of business cycles, where they average a bunch of different models of linear, nonlinear, and asymmetric business cycles to construct a model-free version or measure of the US business cycle. And we also find evidence, high evidence of asymmetric effects. As you notice, recessions tend to be more persistent than expansions. And this is not just a phenomenon phenomenon of the US. Morley and Panofsky extend this analysis to G7 and OECD countries, and they find similar evidence of asymmetry. So there is evidence that the business cycle is asymmetric. However, when we conduct our analysis of business cycles, we need to find a way to decompose any aggregate series into the trend and cyclical component. The HP filter has been used traditionally in the literature and still very widely used. However, it has a number of different shortcomings, and they're well known in the literature ever since the Coughlin-Nason paper. But more recently, Hamilton also argued that it introduces spurious cycles. So Hamilton proposes a specific way to identify a cycle that does not have any of the HP filter shortcomings, or at least that's the claim that he makes, where the idea is to basically run a regression at the business cycle frequency and look at the residuals of that regression as the component of the dynamics that is not explained by the forecastable component of the business cycle. So it's very appealing, it's very intuitive, and it's very easy to implement. So that's why it's gained a lot of attention in recent years. And Hamilton argues that his simple univariate regression is well-defined regardless of whether or not the true variable that generates the data exhibits nonlinear dynamics. So I asked the question, is this approach able to capture the asymmetries that have been widely documented in the literature? So to motivate the analysis, what I'm going to do is to generate data from an observed components model with both linear and Markov switching cycles. The DGP is going to be parameterized using early estimates of the US real GDP analysis that I've mentioned to you before. And then I'm going to formally test and contrast the true transitory components as well as the HD filter transitory components. So I'm going to generate data on a UC model, then I'm going to apply the HD filter to that data, and then I'm going to conduct analysis on that filter cycle. Just to give you a sense of what I'm going to show later, this plots the true transitory component for one artificial series generated using a UC model with the Markov switching AR2 model that comes from Sinclair. And the solid line, that's shown in the dashed line. The solid line shows the extracted filter using the HD approach. And as you can notice here, the true cycle has positive deviations from trend. The true cycle is asymmetric, right? Where the positive deviation from trends are minimal, right? So that is, it's a highly asymmetric cycle consistent with the empirical evidence that I've shown to you before. The extracted cycle from the HD approach, which is shown in dashed lines, is able to adequately capture the negative deviations from trend, the recessions. However, it seems to create spurious positive deviations from trend when none exist in the DGP. And the reason for that is because the cycle is symmetric, right? So what I do then is run Monte Carlo simulations to try to gauge what are the properties of the HD filter cycles compared to the true cycles and compared to the HP filter cycles for since the HP filter is still widely used for both linear and Markov switching models. So this is the standard garden variety UC model where output is going to be thought of two components, two non-observable components, a trend, which is modeled as a standard random walk process, and a cyclical component that is going to be stationary. And so the simulations, I'm going to change different parameters in the simulations. The samples are going to be small and large to capture small sample biases or potential small sample biases. I'm going to play with the persistent parameters in an AR1 and Markov switching AR1 process to determine how the properties of the cycles are affected by the persistence parameters, since I have a previous paper where they argue that persistence can alter the effects of linearity tests in this context, as well as the asymmetric effect on those cycles, since the asymmetric effect also has an effect on linear tests. I'm going to run 1,000 simulations. I'm going to compute frequency of rejections at 5 and 10% significant levels. I'm going to conduct testing using the SUP-LR statistic and the asymptotic distribution from Kuo and Chuo. They have a recent paper where they derived the entire asymptotic distribution for Markov switching models, which has been an issue in the Markov switching literature. But these they showed that these SUP-LR statistic has high empirical power, certainly higher power than the tests that have been available prior to this. So I do that, and I generate a UC model with a linear cycle, right? So the true cycle here is a linear AR1 transitory component. And what I do is I test that linearity for that true cycle. So panel C here in the table shows the size of the Q and Chuo test, which is very close to their estimates. That the test is a little bit oversized. However, it does a decent job of capturing the linear properties of the cycle. And then I extract 2 cycles, the HP filter and the HD cycles, from the true UC model. And what I find here is that when the process is not very persistent, the cycle, the HD filter cycle, seems to have properties that are consistent with those of the true cycle. However, when the process is more persistent, the frequency of rejections is significantly higher than the size of the test. And this is exacerbated in larger samples. So there seems to be already some distortions introduced, even in the simple case of a linear cycle. When I generate a UC model with a Markov switching cycle and do the same analysis, the test has relatively high power, especially for large asymmetric effects, close to 80, 90, and 100% frequencies of rejection of the null hypotheses. However, for the case of the HD filtered cycles, the power of the test, even for a highly asymmetric process, it's low relative to the power of the test. If you compare, for instance, low persistence, high asymmetric effect, frequency of rejection, 11% compared to the 80% empirical power of the test, it's very low, right? Same is true for a highly persistent process and a highly asymmetric process, 56% compared to 96, 25% compared to 99. So the HD filter does not seem to do a good job of capturing true nonlinear asymmetric properties on the true cycle. On the other hand, if you look at the frequencies of rejections for small asymmetric effects and high persistence of the series, you find that the frequency of rejections, 23 and 66%, is actually higher than the empirical power of the test, 10% in both cases, small and large samples, which suggests, again, that the HD filter is introducing spurious nonlinearities consistent with the previous results. And the intuition for this is because, if I go back to this figure here, the intuition for this is that if the true cycle is asymmetric, like the solid line, because of the symmetry of the HP filter cycle. Remember, the cycle is computed as the residuals of a regression, which by assumption is symmetric, right? Symmetric around zero, has to have a mean zero. This means that whenever there is a negative deviation from trend, which the cycle captures appropriately, it has to be compensated by a similar positive deviation from trend, so that the average is indeed zero, right? So any negative deviation from trend has to be matched by a positive deviation from trend of a similar magnitude, even if none exists in the true data generating process. And that's what's generating these spurious non-linearities in some cases. So the positive deviations from trend are proxying for a larger difference in the mean growth rates of the two states. And that's what's generating this higher than the empirical power of the test frequency of rejections of the table that I just showed to you. So that's the main take of the paper. I conduct a bunch of different robustness checks to a time varying trend, since there's evidence, vast evidence of unit roots, as well as structural breaks in productivity in the US trend. And we know that standard filters, like the HP filter, Baxter and King filter cycles, produce or are more likely to produce large spurious cycles in the presence of stochastic trends. So I do the same analysis for a stochastic trend, and the results are virtually unchanged. Same issues when the true transitory component is linear. Same issues when the true transitory component is a Markov switching process. I do the same for the case of symmetric nonlinearity, right? So far I've only dealt with nonlinearity that is of the asymmetric type. We can think of business cycles that are nonlinear but symmetric, right? Symmetric deviations around zero, for instance, and again, the results are very similar. They hold in this case as well. And when I ask the question, is this driven by the specific model with which we're trying to capture nonlinearities? So a competing model to the Hamilton-Markov switching model have been these threshold models introduced by Tong and symptotic theory developed by Bruce Hansen and other people. So I asked the question, are the results robust to an alternative form of modeling nonlinearities using threshold models, which are very similar to Markov switching models, except that the threshold variable is actually observable, whereas the regime switching in Markov switching models is driven by probabilistic events. And the results for the size of the test are similar for the less persistent case. However, in the threshold model case, we don't observe these spurious rejections in the linear cycle, suggesting that the distortions occur exclusively in the case of the Markov switching model, but not in threshold models. We don't observe those spurious frequencies of rejections for the low asymmetric or low symmetric or nonlinear effect in high persistent processes. There's still an ability to capture nonlinearity in small samples in particular, but certainly not those distortions as in the case of the Markov switching model. And I'm running out of time, but linearity test is just one way to understand and look at the properties of business cycles. If I do a similar analysis from a different perspective, capturing business cycle features, so there's an entire features literature that looks at certain statistics of cycles in the US. So what we need here is to find an algorithm to estimate or find cycles in a given time series. There's a couple of ways to do that, and for the interest of time, I'm just going to skip the details. I'm going to look at capturing the cycles from different models of GDP through cycles, as well as an observed components models with linear and Markov switching models through and filtered using Hamilton and the HP filter approach. What we find here is that the business cycle features are not, we can't replicate them with HD filtered cycles. We can with the true cycles from an UC model with Markov switching dynamics in the linear cycle. However, these blue quantiles show an inability of these data simulated using this model to replicate true business cycle properties. And what we see is that those blue quantiles occur primarily in the case of the HD filter cycles. So to conclude, what I find is that the approach of Hamilton is unable to replicate nonlinear features of the business cycle, at least in the US, and that it in fact introduces some distortions and spurious nonlinearities because it's forcing positive deviations from trend when none exist in the true DGP. So I'll conclude my presentation here. So thank you for all the presenters. We have, I guess, a couple of minutes for questions in case anyone has questions for any of the presenters. I'll ask a quick question if no one has questions. I had a couple of questions for Pablo, if that's okay. So I was wondering, Pablo, what is the identification strategy that you use in your VAR? Because I saw in the IRFs that the Q and M in your model seem to be correlated. So I'm wondering how you identify those shocks in the VR.
Cholesky ordering. It's just a Cholesky ordering type of identification. I've done also, so not in this paper, but in robustness tests in the, like using local projections by Jorda, a la Jorda, and I've also used generalized IRFs, and the positive relationship still holds. Obviously, the shape is not the same, but I still get the positive movement.
All right. Are there any other questions for any of the other presenters? All right. Then in the interest of ending on time, then I'm going to call the end of the session. I think it's going to 10:15. In my time zone, it is 10:15. So again, let's thank all the presenters for all the very insightful information that has